125 points higher on the Nifty.
So as we speak, we're up close to about 3/4 of a percentage point, 17,743, a gain of 120 points.
Key today has been the Bank Nifty. We highlighted this in the morning as well, that yesterday the Bank Nifty sort of underperformed a bit and took, started the day at 5-day exponential moving average. It was a very strong day. The bulls in control.
Welcome to CNBC TV18. You're watching Markets Today, the show where we track about 6 hours of the trading action in just 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. The bulls claw back on the Wall Street. Sensex and Nifty move closer to their highest levels in a month. Financials lead the charge with the Nifty banking index hitting a 11-month high. Crude oil prices plunged to 7-month lows, with Brent dropping well below the $90 mark. Gives a fillip to stocks of oil marketing companies. War of words between Russia and European Union over attempts to cap the price of Russian gas imports. Nifty Bank soars 2% to hit its highest level since October 2021. This as bond yields stumble to 4-month lows courtesy of plunge in crude oil prices. Container Corp holds firm on a swifter divestment hope after the railways unveils a new land license-free plan with a longer tenure and lower rate. But the caveat of competitive bidding keeps analysts guessing. Indigo co-founder and former director Rakesh Gangwal sells a small 2.8% stake in Interglobe Aviation that runs Indigo Airlines. The small slice of his over 36% stake kicks off what is likely to be a gradual drawdown. The stock slips. And here's the lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Jim McFarty from Nomura, and in Corporate Voices, we have Anil Singhvi, who's the executive chairman of Sri Digvijay Cement. Okay, a lot of action on the Wall Street today, so let's start with that. Sensex and Nifty are now closer to their highest level in a month after the bulls clawed back some of the recent losses. Sensex gained over 600 points and the Nifty gained over 170 points. Bank stocks led the rally, with the Nifty Bank Index ending at its highest level in 11 months. Anuj Singhal is here with the market wrap. Anuj.
Well, the market, the bulls are dominating this market. They, clearly have control of this market. It was visible yesterday when the market made a comeback, and today that comeback was completed. The Nifty was up 1%, but the Bank Nifty really stands out with 2% rally. The Indian market, in fact, has been the best performing market this month and even this year among the larger markets. Weekly expiry, of course, today also helped in terms of short covering, and the Nifty has managed to make a higher closing high, which is something which is technically very positive. As I said, financials did well, so names like Axis, ICICI, SBI led from the front. Cement, for second day running, big gains in both Shree Cement and Ultratech Cement. IT also chipped in today with names like Tech Mahindra, Infosys and Wipro leading the gains. The only pocket where we saw some losses today was metals. So Hindalco and Tata Steel were both down. And in the F&O space, some big gainers, Metropolis, BPCL and City Union Bank. All in all, a very strong session.
Oh yes, a very strong session. Anuj, thank you so much for that analysis. Let's get you some market opinion now. Pramod Gubbi of Marcellus Investment Management said that India continues to stand out versus other emerging markets. He also continues to remain positive on financials. Take a look.
I think whether a broader slowdown in the world will affect India, of course it will. We are living in a globalized world, increasingly so. So we will certainly get affected, particularly, say, export-oriented sectors will face that demand. If interest rates go up, capital flows and cost of capital will also take a hit. But having said that, amongst all other emerging markets, relatively speaking, I think we do stand out because, fortunately or unfortunately, we don't have a thriving export sector compared to some of our other emerging market peers. I think we have made enough changes as far as reforms are concerned, as far as infrastructure is concerned, as far as our financial markets are concerned, to chart our own course for the next decade or so. I think financials, like I said, is a big theme, given that it plays into rising inflation and as a result, rising interest rates. And if we do believe that we are due for a capex cycle in the country, credit growth should also pick up. We're already seeing numbers that we haven't seen for a long time, 14% non-food credit growth in the banking system. I'm not sure how many of us remember seeing that sort of number. So we're clearly seeing a benefit both in terms of loan growth as well as margin expansion for banks and better funded NBFCs.
In fact, let's get in more opinion now. Jim McCafferty of Nomura said that Asia as an investment opportunity is a good way of diversifying risks for global investors. He added that India will be a beneficiary of the developments in China. Listen in.
Asia as an investment opportunity actually is a very good way of diversifying risk for the global investor. China is inexpensive on conventional valuation metrics. India, on the other hand, is quite expensive. China, nonetheless, does have a vast number of metrics and tools it can use to manipulate policy and outcome of that. But until we see that in action, I think for now, India is probably going to be a beneficiary of what's happening in China.
Okay, that is some market opinion coming in. But let's move on to the second headline now. Stocks of oil marketing companies soared between 2 and 4% after crude prices slipped below the $90 barrel mark. Manisha Gupta is here with all those details. Manisha?
Well, yes, we are dealing with sharp declines in case of crude oil prices. Good news for India, though, but we are looking at the prices at the lowest in last 7 months. It has been a 5% of a decline overnight, and the prices are where they were prior to the Russia-Ukraine conflict. The pressure comes in on the back of strong US dollar, weak economic data. The Chinese crude imports for the month of August have seen a decline by nearly 9%. And add to that the kind of interest rate hikes that we are seeing globally from central banks. One is expected from the European Central Bank today to the tune of 50 to 75 basis points. We already have seen Bank of Canada increase rates by 75 basis points. And then on 21st of September, you have the US monetary policy meeting as well. And apart from that, the markets also do believe that with the kind of demand growth that we're looking at in this year is weaker than what we saw previous year, also seems to be weighing on, even as Russia says that they will stop supplying oil and gas to countries who are supporters of a price cap. And then you have the EIA report as well suggesting that you are looking at a strong demand growth this year and lower supplies from US. But those factors or fundamentals is something that the markets are not working with right now. So sharp decline, even as we are trading below 90 for both the varieties. Markets do feel that $80 per barrel could be an immediate support for the near term for crude prices. On a week-on-week basis, we have seen 5% of decline for crude. On a month-on-month basis, it is 7% on the weaker side. And that pretty much has been the case with the other crude petroleum products as well. So whether it is gasoline, natural gas prices, all of that trading in the negative on a weekly basis right now.
Okay, so it is a good day for the oil marketing companies. Of course, they tend to benefit if crude prices are lower, which are their major raw material. But, you know, the big story, of course, is the European Union is staring at an unprecedented winter as it braces to impose a price cap on Russian gas in a bid to cut Vladimir Putin's revenue source. As the war in Ukraine nears the 200th day, Putin has threatened to halt all energy shipments to Europe if the price cap were to be imposed. His comments could mean that European nations have to introduce energy rationing in the winter months. The EU has already asked member nations to voluntarily reduce their gas consumption by 15%. Russian state-owned company Gazprom has already shut down gas flows through its key Nord Stream 1 pipeline to Germany. CNBC's Sylvia Amaro gets us the latest on the European Union stance.
President of the European Commission, which is the executive arm of the EU, Ursula von der Leyen, she said that they want to go ahead with a cap on Russian gas prices. Immediately after that, the president of Russia has said that if that ends up being the case, then Russia could cut all supplies of energy to the bloc. But the European Union does seem to stand firm, and the idea of going ahead with these gas price caps is indeed on the table. Let's take a look at what else von der Leyen had to say yesterday.
We aim at lowering the costs of gas, and therefore we will propose a price cap on Russian gas. Of course, the objective is here very clear. We all know that our sanctions are deeply grinding into the Russian economy with a heavy negative impact. But Putin is partially buffering through fossil fuel revenues. So here the objective is we must cut Russia's revenues, which Putin uses to finance his atrocious war in Ukraine.
Von der Leyen also made it very clear that they want to go ahead with immediate measures to support vulnerable households and the businesses. And then ultimately, also important to keep in mind that they want to impose mandatory targets on electricity consumption. So these are a couple of ideas that are just getting more ground ahead of a meeting that's taking place tomorrow. But we have yet to see where the European Union is going to land on these proposals.
Sylvia, thank you so much for all those details. And as we speak, the new British PM has announced a cap on energy bills to combat the cost of living crisis in the UK. Of course, the cap is at £2,500. So they are doing things in order to ensure that the electricity crisis or the gas crisis does not impact the citizens as much as it has been impacting so far. But we'll keep getting you more updates on this one. But moving on to the third headline, Bank Nifty hit 11-month high after bond yields tumbled to 4-month lows thanks to crude prices. This surge in bond prices has led to 6 bank stocks hitting fresh all-time highs. Lata Venkatesh is here with the lowdown. Lata.
Let me start with the bonds, actually. You know, the bond yields went to a 4-month low. The new 10-year went to 7.08 and the old 10-year, a 4-month low of 7.13. We last saw that in early May. Now, the yields are down, obviously, because crude prices have crashed below the $90 mark. There is also this increased chatter of India's inclusion, Indian bonds getting included in the bond index. Tax collections are good. The finance minister made a strong pitch that inflation is getting under control, probably seen as a hint to the MPC to be dovish. So all told, yields have come down from a high of 7.6% 5 months ago or 3 months ago to, you know, almost close to 7%. That's a very big positive for the banking sector. So what did we see on banks? For them, the immediate gain, today's, butter, if you please, or icing on the cake is that their bond portfolio, the bond prices have risen and therefore they make more mark-to-market gains. But, what a finish. Bank Nifty 2% higher and 6 to 7 banks hitting all-time highs or 52-week highs today. It was kind of in the making. We have seen a lot of brokerages like Credit Suisse and Morgan Stanley more recently upping the earnings estimates of private sector banks, in fact, all banks, including SBI, BOB, PNB, increasing their earnings estimates on the strength that margins will be better than expected, credit costs will be lower than feared, and loan growth also will be better than expected. And what we are seeing today perhaps is a culmination or a continuation of this kind of optimism on the banking sector.
Lata, thank you so much for joining us and making sense of what's happening in the banking space, which was doing really well in trade today. With that, we'll slip into a break now, but stay tuned. We'll be back in just a bit with the other headlines. Hi, welcome back. You're still with us on Markets Today, and it's time to go to the rest of the headlines that we are tracking for you. To the fourth headline now. Container Corp gained over 1% after the Railway Ministry unveiled a new land license fee plan with a longer tenure and lower rate. Mangnam Malu is here with what brokerages are making of this move and what it means for the stock. Mangnam.
The fact that the land license policy has been cleared and we got some clarity coming in from the Railway Ministry officials in the press conference today as well. And the brokerages are happy with the fact that now that this hurdle is away, we will perhaps see an accelerated push for privatization, and that's what they're pinning their hopes on. What they aren't pinning their hopes on, or what they haven't factored in their valuations yet, is the potential benefit that will come in, because we are still awaiting the details of the exact benefit coming in from the land license fees, whether it's 6%, whether it's 1.5%, or how much more it will be once it's bid for. But directionally, it's a positive, and that's what brokerages like Credit Suisse have been saying as well. Nomura, for instance, they've left their estimates unchanged, but they've upgraded the stock, so that's an interesting move out there. And Jefferies too believes that this was an important step in the path towards privatization. However, the one brokerage that stands out is Kotak, which has maintained or rather downgraded the stock to reduce after yesterday's development, because they believe that they had factored in a land license fee of 3%, and that hasn't come by. The 1.5%, of course, is prospective and not retrospective. So they believe this is a negative development as per their estimates. And as far as the privatization is concerned, they believe that this is a positive event, but they can't put a number to it.
5 साल को अगर हम ठीक कर दें, we give it a certain 35 years का period, right? 35 years का एक period दे दें और एक clearly defined formula बना दें, तो बहुत सारे लोग रेलवे के साथ जुड़ के अपने मल्टी मॉडल कार्गो टर्मिनल्स बनाएंगे. कोई कॉन्कोर से स्पेसिफिक ट्रीटमेंट नहीं है. दिस पॉलिसी इज अ जनरल पॉलिसी फॉर एवरी पार्टिसिपेंट इन द लॉजिस्टिक्स सेक्टर. किसी भी स्पेसिफिक किसी कंपनी के लिए नहीं है.
Okay, that is about Container Corp. Moving on to the fifth headline now. Interglobe Aviation fell close to 2% after the company's founder and former director Rakesh Gangwal sold a small 2.8% stake in the airline. The small slice of his over 36% stake kicks off what is likely to be a gradual drawdown. Sonia Shenoy is here with all those details and what it means for the stock. Sonia.
Well, thanks a lot for that. So 7 months after stepping down from the Indigo Aviation board and stating that he would sell his entire holding over a period of 5 years, the co-founder of Interglobe Aviation, Rakesh Gangwal, and his family have now started the process of selling their stake in Indigo. The Gangwal family today sold 2.8% stake in Indigo for 2,000 crores. Remember, the co-founder Rakesh Gangwal and his wife Shobha Gangwal together own 23% stake in Indigo as on June 2022. Now, the Gangwal family trust and cumulatively owns about 36.6% stake in Interglobe Aviation. And Rakesh Gangwal had indicated that he would sell his entire holding over a period of 5 years. Now, the stake sale today was possible after the modification in the Articles of Association, which allowed the sale of shares by promoters without seeking the approval from the other. But what this does is puts to end years of dispute between the promoters. Post the stake sale, Gangwal's holding will be down to about 33.8%, while Rahul Bhatia, who's the other co-founder, will continue to hold 37.8% of the airline.
Okay, all right. Interesting times for Interglobe Aviation. Sonia, thank you so much for all those details. From the broader markets, it was Schneider Electric that rallied 10% after the company said that they will enhance their production capacity of vacuum interrupters and circuit breakers. What does it mean for the stock? Vaishta Unwala is here with the details. Vaishta.
Well, Schneider Electric Infra has been the stock in focus today. The company has approved enhancing the production capacity of vacuum interrupters and vacuum circuit breakers by setting up a manufacturing unit in Kolkata. The existing capacity of the company is at approximately 80,000 MV vacuum interrupters with an existing capacity utilization of approximately 90%. Now, the capacity that is going to come up will be increased by 180,000 MV vacuum interrupters and MV vacuum circuit breakers assembly lines. This will require an outlay of approximately 138 crores, which is supposed to be incurred over a period of the next 3 years. Now, the rationale behind this expansion is to meet the domestic demand as well as increase the exports to Schneider Electric global entities to accelerate Atmanirbhar Bharat initiative of Government of India. Now, remember, this expansion has a strong potential to increase the revenues of Schneider Electric. For FY22, the revenues stood at 1,500 crores approximately.
Okay, all right, Vaishta, thank you so much for all those details. Moving on to the other set of stocks that did really well. Cement stocks have been in focus, and uptick in demand due to receding monsoon and upcoming festive season has seen these stocks surge, but cost pressures continue to exist. Even as these pressures exist, consolidation is expected in a market, says Anil Singhvi, who is the executive chairman of Sri Digvijay Cement. Meanwhile, P. Radhakrishnan, the whole-time director and CEO at Kesoram Industries, says his company is not in talks for inorganic growth. Listen in.
So demand has been a little tepid in those areas where monsoon has been heavy, and I expect the prices will inch up in next fortnight or so, because the monsoon seems to be now withdrawing and demand is picking up again. So my expectation is that the prices which we lost during last 2-3 months on account of monsoon will come back again. Cost side pressures are still there. They have not come down except for the pet coke. So industry's profitability obviously is still under a lot of strain. But if the prices move up with the demand in October, I hope margins will come back again from the October-December quarter. You have the first 5 players having capacity to really consolidate the industry further. So I look at it next 2-3 quarters time, there will be definitely consolidation.
Has any of these big players come and said that have approached you? Any kind of discussion?
Absolutely no.
Okay. But what if you're trading at about $60 per ton or less than that? If there is an offer, do you think promoter will be willing to sell?
Absolutely no.
Okay, that is all about the cement industry. A lot of consolidation expected out there. But to the big name now, Infosys's buyback 1-year cool-off period ends today. And Rima is standing by at the big wall with all the details. Rima, does this mean we can anticipate another buyback announcement from the company soon?
Thanks so much for that. So as you pointed out, the buyback period for Infosys cool-off has ended, which basically means that there has to be a one-year gap between when the buyback ends and the next buyback can be announced. Now that the buyback cool-off period has ended, it means Infosys is eligible for a buyback. So the question is, should we expect an announcement immediately? The answer is no. Now, in the last buyback, the gap between the cool-off period ending and the company announcing a buyback was a good 7.5 months. And the one prior to that, it was just about a matter of 2 to 3 weeks. It's possible that the 2021 buyback was a bit delayed due to COVID. The company was considering, saving up a bit on the cash. But the earliest we could expect an announcement is perhaps with its Q3 numbers. That's the 12th of October, because typically Infosys announces its buybacks along with numbers. Now let's understand what the past buybacks of Infosys portray as a 10. For starters, it will be the company's 4th buyback. And the details in terms of the size are up for you on your screen. The 2021 buyback was 9,200 crore. The one before that was 8,260 crore. And the one before that was about 13,000 crore. The last 2 buybacks were open market buybacks, not a tender buyback. And the maximum premium at which the buyback was done, the price at which the company was willing to buy back shares, was close to about 25% in the previous buyback. So in terms of a precedent, what is it that we can expect? Perhaps an open market buyback and no promoter participation. Now let's move on in terms of what Infosys' stated capital allocation policy is. It is to return 85% of its free cash flow over a 5-year period between FY20 to FY24 through a combination of dividends and buyback. And so far, the company has returned 73% of its free cash flow for FY20, 21 and 22 combined. The quantum of dividend being doled out by the company has also started going up, and last year the company doled out or paid close to about 31 rupees in dividend. So now it's all eyes on this cash-rich tech major on when it plans to make a buyback announcement and what the contours of that could be. Back to you.
Okay, we'll watch out for if any other buyback is being announced by Infosys. But move on to the other news. Life insurance companies witnessed strong growth in their premium income for the month of August. New business premium income for life insurers grew by over 18% year-on-year, also registering a 44% growth from year to month. Yash Jain joins us with more. Yash.
Well, good growth for the life insurance industry in the month of August, and it's the private life insurance industry which has performed slightly better. As far as the total industry is concerned, the premium in the month of August, that grew at 18% on a year-on-year basis. Up to the month of August, that is year to month, the premium saw a growth of 44%. For private life insurance industry, the August premium grew by about 24% on a year-on-year basis. Up to the month of August, the growth was about 35%. LIC, August premium grew at 15% on a year-on-year basis, and that's a good number on the large base that LIC has. But the year-to-month premium, that saw even better growth of 49%. As far as the retail APE for LIC is concerned, that grew by about 5% on a year-on-year basis. For HDFC Life, the August premium saw a growth of 15%. Year-to-month, that is up to August, again 15% growth in premium, and retail APE grew by about 16% on a year-on-year basis. ICICI Prudential Life, the August premium, that saw a growth of 11%. Year-to-month premium saw a growth of 19%, though the retail annualized premium equivalent or APE, that shrunk by about 14% on a year-on-year basis. Now, speaking about the weakest spot this time around and the strongest spot, the weakest spot was Max Financial Services. The August premium shrunk by about 1% on a year-on-year basis. Year-to-month premium was up 10%. The retail APE also came down by about 12% on a year-on-year basis. The strongest spot, SBI Life Insurance, August premium growing at 21% on a year-on-year basis. Year-to-month premium up to the month of August growing at 44%. The retail APE though shrunk by about 5% on a year-on-year basis.
Okay, Yash, thank you so much for joining us with all those details. That's about the insurance industry. But with that, it's a wrap on this edition of Markets Day. Thank you for watching.